although I may not look a lot like your traditional clients that you used to work with back on Wall Street, I was originally introduced to your work more recently through Kiyosaki, Robert Kiyosaki, and I was studying economics class. I was studying economics in college, and I raised my hand and I asked my teacher about the Federal Reserve, and I wanted to understand the economic problems that we, specifically my generation, would really be inheriting in the years to come. And essentially what my teacher told me was to be quiet and memorize the textbook. And it
Right.
became an argument in my classroom, and no one in the class they wanted me to shut up too. They just wanted to get in, memorize the stuff, and get out and do whatever else they had going on the rest of the day. And that immediately made me concerned. And shortly thereafter, I dropped out of college and I started my career. And there's two demographics, one of which is around my age, which is about I'm 28, but generally between 20 and 40, and the other is more of a middle-aged demographic that follows my work.
Yep.
And I wanted to know specifically, to start off, your first prediction many years ago when you worked for the Pentagon and the CIA was when you guys did the war games. You ended up being right about the currency wars between China. And I wanted to ask you what you think is the biggest concern to you personally when you reflect on the global economy as of right now.
Well, probably there are a lot of issues. We're in a currency war. We're in a trade war. We have slowing economic growth. In recent days, both Germany and the UK have reported that their GDP declined, which is halfway to a recession. So it's not just a slowing growth is one thing, but a recession is something else. You're actually your output is declining. China's growth is slowing dramatically. So you look around the world, you see at best slowing growth, at worst signs of recession, and trade wars and currency wars, which are all major headwinds to growth. So the economic landscape it's not a disaster. It's not Jake, when you're in my position, people love to put words in your mouth, and they'll say, Jim Rickards says this, says that, most of which I never said. But I've never said it's the end of the world. I've never said it's an apocalypse. I have said that we are at risk of a financial crisis, potentially worse than 2008, and we're certainly at risk of a recession right now. So those things are pretty easy to see. But the biggest problem is in all this slow growth, recession, headwinds that we're seeing at the same time, debt keeps going up. And a lot, by the way. We're back to trillion-dollar deficits last seen in the early years of the Obama administration. Obama ran trillion-dollar deficits in 2009, 2010, 2011. Then they got it under control. In a manner of speaking, the deficits were still, $500 billion a year, approximately, order of magnitude. But that was down from $1 trillion. But now Trump is back to trillion-dollar deficits. And I make the point that this is really bipartisan. It's not a question of blaming Democrats or Republicans. It's bipartisan incompetence. But we're back to trillion-dollar deficits. And one of the things you have to ask yourself is, okay, is the deficit is the annual negative. It's basically the excess of spending over income. So you take in $3 trillion of taxes and you spend $4 trillion in the budget, you have a $1 trillion deficit. That's an annual concept. The debt is the accumulated debt, all the deficits since George Washington. And what's that number? The answer is today it's around $23 trillion. But it's going up $1 trillion a year. And you say, well, okay, is that high or low? You really can't think of debt and deficits in the abstract or just in relation to a number. You have to compare it to the income. And the way I explain that is, let's say you owe $25,000 on a MasterCard. Is that high or low? Well, the answer is it depends on your income. If you owe $25,000 on a MasterCard and your income is $20,000 a year, you're in trouble. You're probably headed for bankruptcy. But if you owe $25,000 on a MasterCard and you're making $300,000 a year, that's a comfortable debt level. You can probably just write a check and pay it off. So you can't decide whether a debt is a problem or not unless you look at the income. And the way to do that is take what's called the debt to GDP ratio, the GDP, gross domestic product. So how much debt does the United States have? Divide it by what's the gross domestic product. And look at that ratio, and that'll tell you if the debt is comfortable or out of control. So a comfortable
And is there
level.
a historic ratio that generally economies end up having a depression or a recession in?
Well, it's a funny thing. A depression can actually make the debt to GDP ratio go down because your growth is so. Actually, I misspoke. Make it go up because your growth is so low. Because you've got a numerator and a denominator in the fraction. The numerator is the debt, and the denominator is the GDP. So if your GDP is declining, which it does in a depression or it can in a depression, your ratio could actually be going up, not because your debt's going up, but because your economy is going down. We're in the opposite situation. The economy is growing. It's not growing very strongly. This is the weakest recovery, at least since World War II, possibly longer, or the end of World War II, possibly longer. But the debt is going up a lot faster than the economy is growing. So that ratio is going up. So if you said, what's a comfortable ratio? 30%, very comfortable. Any developed economy with a growing economy and with a 30% debt to GDP ratio, that's fine. 60% gets to be a little bit of a red flag, and that's where Angela Merkel is trying to keep Europe. Under the Maastricht Treaty, that's the treaty that forms the European Monetary Zone, the euro, the countries that belong to the euro. She's trying to keep that below 60%. But there's another threshold, which is 90%. 90% is in the danger zone. That's the real red zone. And what happens, this is based on research by Ken Rogoff and Carmen Reinhart, two very prominent economists at Harvard University, but both in their book, This Time It's Different, and also in a number of papers they published, which are publicly available. And this, I put all this in my book, my new book, Aftermath, so you'll find all the citations there. But they say at 90% or above, the debt itself slows down the growth. Now, the theory of government debt, this comes from John Maynard Keynes in the 1920s and 1930s. He said there are times when a country is in a liquidity trap. Liquidity trap just means people don't want to spend for whatever reason. They're fearful. They're worried about the stock market, et cetera. They don't want to spend money. They don't want to borrow. The banks don't want to lend. People just want to save their money. It's called hoarding. Well, how do you run the economy if nobody's spending and everybody's saving? Well, Keynes' theory was, well, the government can step in. The government can run deficits. The government can spend money. That will increase what's called aggregate demand. And little by little, you get the economy moving. And so if the government borrows $1 and spends $1, you might get $1.50 of GDP. Well, how do you get more GDP than the money you spent? Well, the answer is the money turns over. So I'm the government, I hire somebody to do something for me. That person gets paid, but then that person goes out and spends the money on a subcontractor, and that person spends the money, takes the spouse out to dinner, whatever, and then that's called velocity, which is the turnover of money. So when you're starting on a low level, you're coming out of a recession, you're in a recession or in a depression, you're in a liquidity trap, and you spend a little bit of money, you can actually get more GDP than the amount you borrowed. And sometimes it can be a lot more. You can borrow and spend $1 and get $1.50 of GDP. Well, that's good because your economy is growing faster than your debt. But there are limits to that. And the limits are it works better early in an expansion or in a recession. It works better when you don't have too much debt to begin with. It works better when you have a lot of excess capacity that can actually be put to use, meaning a lot of unemployed people who can come back to the workforce, unused industrial capacity that can be expanded. So those are the conditions under which this, what's called the multiplier, getting more than $1's worth for $1 spent, works. Today, we're in the opposite of all those conditions. We're not in a recession. We're in the 11th year of an expansion. We don't have a low debt to GDP ratio. We have a very high debt to GDP ratio. We don't have a lot of slack in unemployment. Unemployment is the lowest in 50 years. It's 3.7% or 3.6%, the lowest since 1969. So none of the conditions that Keynes outlined to say, well, here's where you can get some bang for the buck, apply. And what Rogoff and Reinhardt point out is that when you get above 90% debt to GDP
And what
ratio,
are we? We're at about 120. Is that what you said?
we're at 106. But
106.
going up a couple points a year. It'll be 107 next year, 108. The highest since World War II. By the way, World War II was 120. That was the all-time high. But
Okay.
I make the point, well, yeah, but we fought World War II. We won. So we had 50% of global output. So you got something for the money. And this put the U.S. in a global hegemonic position. So, yeah. And by the way, between 1945 and 1980, that debt to GDP ratio was whittled down from 120% to 30%. Now it took 35 years, and Republicans and Democrats. It was Harry Truman and John Kennedy, and Lyndon Johnson, and Jimmy Carter for the Democrats, and you had Dwight Eisenhower and Richard Nixon and Gerald Ford for the Republicans. So both parties worked on this together. The Fed and the Treasury, the country as a whole, kind of came together, and we got that debt to GDP ratio down from 120% to 30%, which is.
And what are the genuine consequences of this increasing ratio, where someone might say, okay, well, obviously their plan is just to basically close their eyes and keep printing more and more and keep ignoring it. What are the actual consequences for someone that may kind of understand the things that you're saying, but when you break it down to the most simplistic term and you say, as our debt is continuing to increase and our GDP is starting to slow and global GDP is starting to slow, what are the actual consequences of that for you and I and someone listening that is like, I'm not an economist, I'm an entrepreneur, I don't really pay any attention to that, I'm just focusing on making more money. What are the consequences of this?
Well, the main consequence is slower growth. In other words, instead of more debt being an engine of growth, more debt becomes a headwind to growth. It slows down the growth. Now, think about that for a second. So I said, at low levels of debt and a lot of unused capacity, you can spend $1 and get $1.50. That's pretty good. That's a good payoff for $1. Today, we're in a world where you spend $1 and you only get 90 cents. You don't even get the $1 back.
Got it.
So that's a headwind to growth. Why is that a headwind to growth? Because people aren't stupid. They look at the situation, as you say, Jake, they may not be economists, and you don't have to be, but you say, well, wait a second, this debt looks like it's out of control. Something's going to happen in the future. Either there's going to be a default, which is unlikely because we can print the money, but it's something you put on your list, or they're going to tax me more. Like, how are we going to get out of this? Well, I'm going to have to pay higher taxes. So I better save more today to get ready for those taxes coming down the road.
And that's how I feel right now. I feel like trying to take advantage of this right now as much as possible.
Yeah. And then the third thing is it's non-sustainable. You could have a credit crisis. So there are a whole set of bad things that could happen. A credit crisis is one. Default, not that likely, but possible. Higher taxes, definitely possible. And if growth slows enough, you get into a recession. Now what are we talking about? Lost sales, higher unemployment, losing your job, defaulting on your mortgage. All the things that we saw in 2007, 2008 will come back because of this debt problem. So that's the situation we're in. Now, a lot of people think, well, George Washington came in 1789. There was no debt, and it's been going up ever since, and now we're at $23 trillion. That is not what happened. First of all, when George Washington became president in 1789, we already had debt. We had national debt before we were a nation. It was debt left over from the Revolutionary War.
You want to do a quick quiz? I think I remember from your book that what is it? 80% of the debt that we have right now has come in the last, what was it? What did you say? 14 years?
The last 20 years.
Last 20, okay.
Yeah, it is 80%. I mean, just to kind of cut to that for a second, when Bill Clinton left office in 2001, January 2001, the national debt was $5 trillion. George W. Bush doubled it from 5 trillion to 10 trillion. Obama doubled it again from 10 trillion to 20 trillion. And then Trump has added a couple trillion since then. So so in other words, 19 years ago, or not even 20 years ago, the debt was 5 trillion. Today it's 23 trillion.
Okay.
So what's 18 divided by 23? It's over 75% of the debt has come in just in the last 19 years. So, and that breaks a pattern. And I talk about this in my book, Aftermath. Again, going back to George Washington, debt didn't go straight up for 200 years or 230 years. It went up and down and up and down. It was a sine wave. Well, what caused it to go up? Well, the answer is war. It went up during the War of 1812, the Mexican-American War of 1848, obviously the Civil War, the Spanish-American War, World War I, World War II. Those are times when the debt went up. When did it go down? In times of peace. So after the war was over and the U.S., pretty much always won, then you would grow the economy and pay down the debt and not borrow as much and even run surpluses. A lot of presidents forget about deficits. They ran surpluses. Calvin Coolidge, Warren Harding, even Richard Nixon, even Bill Clinton had a couple of years of surplus. So the idea is debt goes up in time of war. It comes down in time of peace. And overall, it stays within balance and it stays manageable. And as I say, as recently as 1980, it was only 30%. What changed, beginning with George W. Bush, but continuing through Obama and Trump, and again, I think it's important to make the point, this is bipartisan. This is not Democrat versus Republican. This is, I would say, globalists versus nationalists, or elites versus people more in touch with the American people. Suddenly, okay, so Bush had 9/11, that requires some money, but Iraq was a war of choice. We didn't have to go into Iraq. Obama did not have any new wars. Trump has not had any new wars. So based on this historic pattern that goes back 230 years, what we should have seen in the last 10 years, let's say, is the debt to GDP going down.
Okay. So the concerning thing is that it's went up while we've been in peace.
Correct. That was the pattern that prevailed for 230 years is broken. Now, it didn't go straight up for 230 years, but it is going straight up now. So we used to have bipartisan responsibility. Now we have bipartisan irresponsibility. And so then with that as the background, that flies right into the research of Reinhardt and Rogoff, which says, oh, by the way, when your debt gets to that level, and today we're at 106%, way past the 90%. They identify 90% as the place where you cannot borrow your way out of the problem. Up until then, you can borrow, get some growth, grow the economy faster, pay it back, make it sustainable. People always say, well, you can't pay off the national debt. Well, you don't have to pay off the national debt. What you do have to do is roll it over. In other words, you need to maintain the confidence of the markets. You can borrow new money to pay off the old money and keep doing that, provided that creditors view you as creditworthy, provided creditors, investors basically think that you're managing it in a responsible way. And this was the great insight of Alexander Hamilton. Alexander Hamilton is this, liberal progressive hero because there's this Broadway musical, and I guess he comes off okay in the musical. But in real life, what he did when George Washington came in, Alexander Hamilton was Secretary of the Treasury, and they said, what do we do with this Revolutionary War debt? We can't pay it. And the Congress said, well, that's easy, just default. It's the American way, just don't pay it. And Hamilton said, no, let's borrow more money and pay it off. This will establish our credit, we'll be creditworthy, and then we can borrow even more money and pay off the first borrowing, and then borrow more money and pay off the second borrowing, and so on. This was the creation of the formation of the U.S. government bond market. This is when it started. And Hamilton's insight was, you can always, if you're creditworthy, you can always borrow new money to pay off the old money and just keep it going. And it has been going for, as I say, over 230 years. But there's a condition on that. The condition is that you have to manage it responsibly. You can't let the debt to GDP ratio get out of control. And for times when you're borrowing more, there has to be some other time when you're borrowing less and paying it off and keeping that ratio in line. That was Hamilton's great insight. It has worked well. He was right. So you don't have to pay it off, but you have to make it sustainable so you can roll it over. The problem today is we've run off the rails. We're not paying it off. We're not reducing the debt to GDP ratio. We're not acting responsibly. And we're getting closer to the point where both U.S. citizens and global investors are going to say, you know what? I don't know what's going on here, but get me out of here. Get me out of the dollar. Get me gold, silver, land, natural resources. I'll buy a new car, a new refrigerator, buy a house. I'll do something, but I got to get out of the dollar in these bond markets because I don't trust the ability of the United States to manage this. That's when you have your debt crisis. So if you say to me, what are the problems of this? Number one, the debt itself impedes growth, so you cannot grow your way out of the debt as we had been doing since Alexander Hamilton. You can't do it. Number two, people see this happening and it actually gets worse. They start to save more and spend less, so that's another headwind to the economy. Or three, they ditch the dollar completely, get into hard assets, then you have a credit crisis. Or four, the Fed says, well, why don't we just get some inflation and make the debt go away? The thing with inflation, it's like watching an ice cube melt in your hand. You know, if it hold it there long enough, it goes away. If you have enough inflation, the debt is still there in terms of dollars, what they call nominal debt. It's still there, but it doesn't cost you as much. It's like saying to China, hey, we owe you $1 trillion, print it up, fly it over there. Here's your $1 trillion. Good luck buying a loaf of bread. In other words, we make the debt go away the way you make an ice cube melt. You just inflate it away.
Right.
That's the American way. The problem with that, I'll finish quickly, the problem with that is the Fed's been trying to get inflation for 10 years and they can't do it. Like you say, it's a sad day when a central bank wants inflation and can't get it. They should be able to get it, but they can't because they don't understand inflation and where it comes from. But so if you can't grow your way out and there's no need to default because you can print the money and you can't get the inflation, what do? Well, the answer is you just keep going down the road and increasing the debt to GDP ratio until you have a credit crisis. So I can't say exactly what will happen, but I can say it will be one of several things and they're all bad.
So, James, obviously, especially someone that isn't particularly interested in these types of topics, it even for me produces a lot of anxiety. And at the same time, I continue to study it so that I, at the same time, minimize long-term anxiety. And yep. I was wondering, so for people that are not that are not familiar with you, you were, I don't know every in and out of your career, but you were quote unquote traditional. You were you're a hedge fund manager. You've worked with the Pentagon. You've worked with the CIA. What made you jump on, and I call it facetiously, the crazy train? You went from you were a lot more traditional, and now you're talking about things that no one wants to talk about. What brought you to this position right now in your outlook and your interest in studying the economy? And did you always know this stuff, but you played a little bit more of the mainstream Wall Street game, but you always knew this? Or what brought you to this different type of way you're looking at things?
Yeah, I kind of always knew it, and I can explain why. I would say that if you looked at my resume, I don't even do a resume anymore, but if I had one, you'd look at the jobs and you say those are pretty traditional jobs, and they were. But I don't think I was ever a traditional thinker. That's two different things. So yeah, I was International Tax Counsel to Citibank for 10 years. I was general counsel of one of the biggest government bond dealers for 10 years. I worked in a hedge fund for 6 years from start to finish, long-term capital management that almost, destroyed the world in 1998. I was not the risk manager. I'm glad to say I was a lawyer, but I negotiated the bailout of Wall Street banks that put $4 trillion in to support the balance sheet. I ran a stock exchange. I worked at a couple other big hedge funds. The CIA thing was different because that was after 9/11.
Okay.
There was insider trading before the attack, and they were looking for financial and derivatives and options experts to help them understand that and build a machine that could predict the next 9/11. And I was one of the ones that was tapped to help that, and I was there for over 10 years. So yeah, a lot of, CIA is a little out of the box, Pentagon, but a lot of, banks, hedge funds, exchanges, government jobs, kind of traditional in that sense. But going back to when I was, 9 years old about 9 years old, my father fought in World War II. He was in the 1st Marine Division, 1st Regiment, and they fought some pretty tough battles. But after the war was over, he was part of the occupation of China. The U.S. went in to occupy China because China was a mess. and we were supporting the nationalist government against the communists. But when I was a little kid, he would say, yeah, my buddies and I, when we had to, wanted a case of beer, we had to take a wheelbarrow full of Chinese yuan down, all the notes we could carry and more, to get a case of beer. And a lot of people, they've heard of the Weimar inflation of 1922, and that was a big deal, and they had wheelbarrows full of money. That
the other book, I read that recently on When Money Destroys Nations, about the Zimbabwe collapse.
I haven't read that book, but that would be another good example. There are many examples of that. But what's different about Zimbabwe is that it still is a developing economy, not a developed economy. Germany was a very developed economy.
Fair enough, yeah.
Maybe, I think, first or second largest economy in the world, with a highly educated population, a large industrial base, and they got into the hyperinflation. So a lot of people have heard of that, but I first heard about it in China, and it turns out that Chinese 1946 hyperinflation in China was worse than Weimar, and there have been many other examples. So I kind of grew up as a 9-year-old hearing about wild inflation stories from my father, who was a really smart guy, but not an economist. But he, when you need a wheelbarrow to buy a case of beer, there's something wrong with the money. Yeah. But he used to, he would reach in his wallet and he'd pull out a $20 bill. But he had another $20 bill that he carried around that was much older. And the old one said, if you read the top, where I went to law school, the first thing they teach you is read the contract, right? Well, a dollar bill or a $20 bill is a paper contract between you and the United States government. They're saying, here's the money, and if you're interested in what it is, read the dollar bill, read the bill. Well, it says on the new ones, it says Federal Reserve note. Well, where I went to law school, a note is a liability, and indeed, money, what people call money, you would consider it an asset, or I would consider it an asset. But from the government's point of view, it's a liability. You go look at the balance sheet of the Federal Reserve System. It's publicly available online. Money is a liability. It's the stuff that they print that they owe to you. For you, it's an asset, or for me, it's an asset. So first of all, what we call money, in my opinion, isn't really money. It's a liability of an insolvent.
This is why we have Kiyosaki going like this all the time, that savers are losers, right?
Exactly. That's right. But what we call money is really a liability of the Federal Reserve System, which is on a lot of occasions insolvent. They have no capital. I had dinner once in Vail, Colorado, as a private dinner, small group, 6 or 7 people at the table, with one of the governors of the Federal Reserve System. And I said to her, it was after a glass of wine, I said, you work for an insolvent bank. And she said, no, we're not. We're not insolvent. No one has done that math. I said, well, I've done it. I think others have done it. You're insolvent. On a mark-to-market basis. They don't keep their books on a mark-to-market basis. But mark-to-market just means if you took everything, marked it down to today's value, they were broke. Okay. And so then I said, yes, you are. And she said, wow. She kind of harumphed and said, central banks don't need capital. Well, think about that. I think that might come as news to most Americans, that our central bank has no capital, or on a mark-to-market basis is insolvent, and that's true. But but money, so-called, is a liability. But then my father had this other $20 bill, and it said silver certificate. And it was from a time prior to the 1930s when you could take it down to the bank and they would give you silver.
That's cool. Do you still have that dollar bill?
I don't have that one. I have a $100 bill from 1933 stashed away somewhere. But when they said silver certificate, what they meant was the bill, the $20 bill or $10 bill, whatever it was really like a warehouse receipt. And there was supposed to be some silver or gold in a vault somewhere. And you were walking around with this paper, but you could take it down and get that much silver. And at the time, it was an ounce of silver, but it was real silver. If you have a quarter or a dime in your pocket, it looks silver. It's not. It's like zinc and coated with aluminum or something. When I was a kid, when you had a quarter, it was a quarter of an ounce of pure silver, and that's what it meant. So I kind of grew up with this notion. My father would say the money's not backed by anything, and he was right. And American money reminded him of the Chinese money that he had bumped into in 1946 when you couldn't buy a case of beer with less than a wheelbarrow full. So that instinct that money is, it's a very hard concept to define. People don't know what it is. They think they do, but they don't really. It's all based on confidence. Confidence is very fragile. It can be lost and destroyed, and it's impossible to recover. So that's why certain kinds of money, they're money one day, and then you wake up the next day and it's like, get me out of here. It's like a house on fire. You just want to get outside. Well, it's happened time and time again throughout history. We're not at that point with the US dollar, but we seem to be pushing the envelope. We seem to be saying, well, how far can we take this? This is
But what
playing out.
made you go from, someone, especially people that are very outside of the box, will say, if you spend, which I'm sure you've heard many times, people will say that really you're just part of the same elitist industry, right? And so you were very much involved in it, but now you're not. And my question is, what made you want to go on something where you probably had so much less resistance to something now where people really outside of the box say you're a shill for the elitists, and then the people inside the box say Rickards gone crazy? What made you take this transition into something that made you much more of a target on both sides of the fence?
Yeah. Again, just kind of going back to, so let's just take a little digress a little bit to 1974. 1974, I got a graduate degree in international economics. That was the year I graduated. That happens to be the last class in which gold was ever taught as a monetary asset. I tell people, if you're younger than I am and you know anything about gold, you either went to mining college or you're self-taught, because the universities just stopped teaching it. They don't teach it. They don't even teach it in an economic history class. But Nixon went off. People say Nixon went off the gold standard in 1971. That's not exactly right. What he did was he suspended the convertibility of dollars into gold. So if you were a trading partner of the United States, Netherlands, Italy, France, whoever, and you ran a surplus, you could take those dollars and you could buy treasury bills, but you could take them to the treasury, and the treasury would have to give you gold. It was convertible into gold at $35 an ounce. That's what Nixon suspended. He said, sorry, we're not converting anymore. He didn't intend the end of the gold standard. In fact, there were a handful of people at Camp David that weekend. It was August 15th, 1971. It was a Sunday evening. Nixon interrupted the #1 TV show in America, which was Bonanza, to give this speech, announcing this. And the gold thing was like the third thing on the list. He was imposing wage and price controls on the entire economy, and then he finally got around and said, "Oh, by the way, I'm suspending the convertibility of gold." But I spoke to two of the people who were there, who were with him. Paul Volcker was one of them, and the other fellow was the dean of the later dean of the University of Chicago Law School, who was a lawyer for the Treasury at the time. And I spoke to both of those individuals, and they told me that they thought it was temporary, that it was sort of a timeout. We're not going to convert to gold, but that's only to give us enough time to have another international monetary conference like Bretton Woods, change the rules of the game, devalue the dollar, and then go back to the gold standard at the new valuation. Now, none of that ever happened. They did have a conference. They couldn't agree on gold. Under the influence of Milton Friedman, one by one, people were going to floating exchange rates. And finally, Nixon just said, fine, whatever, let's do float. But then he got caught up in impeachment hearings, and then he had to resign, and then Gerald Ford comes in, and there was a lot else going on at the time. But the point being, they didn't think it was the end of the gold standard. So it took about 3 years for what I just described to play out. So as late as 1974, I still had to, when I was learning about the International Monetary Fund, I used to still sit down with a national balance sheet and look at gold reserves and think of it as money. That ended abruptly in 1974. Okay. We now have 2 generations of scholars and students who have not been taught a thing about gold. The mainstream economists disparage it. They say it's a joke. Barbarous relic. Keynes never said that, by the way. And I wrote a whole book on this called The New Case for Gold. Right. But so between being a 9-year-old and having your father tell you that there's a difference between a silver certificate and a note, talking about inflation in China in 1946, then going to graduate school and actually learning gold, I just had this legacy that I carried forward. Okay. Now, did I have establishment jobs? Yes. But I would say that I never quite thought like the establishment. I always had doubts about this. I always wondered what happened to gold. I mean, I knew what happened to it, but why it was abandoned the way it was. So rather than thinking that I had this very establishment career and I suddenly went rogue, that's not true. It was more the case that I was always a little out of the box, but I study the system from the inside. When you're general counsel of the world's biggest bank and you're general counsel of one of the world's biggest government bond dealers and you're running a stock exchange and you're working for the CIA and you're working for the Pentagon, and I've been in the boardroom at the Federal Reserve and I've met a lot of these officials and I've spoken to them one-on-one, including the head of the IMF. When that's your experience, you know as much about the system or more about the system than anybody. So I have the benefit of inside experience and understanding the architecture and the plumbing of the system on the one hand, with a heterodox view of what money is on the other. So that's who I am, and that's kind of where I am.
And did you just get to a place in your career where you said, I'd like to explore this aspect more, and that's what prompted you into moving more into the work that you do today? Or what you just got to a point where you said, I'm more interested in this now?
Well, what I would say is that understanding the architecture of the system and understanding the stress points, when you see, it's one thing to say like the foundation might be a little creaky or there's some cracks in the foundation. It's another thing when the building actually starts to topple over. You don't just, you might want to get out, you might not want to be in the building, but you want to help other people as well. So I would say I'm uniquely positioned to see the stress points, to see the difficulties coming. And my motivation wasn't, I can take care of myself, I can take care of my family, but by writing books, giving speeches, doing consultations, flying around the world, using social media. I'm very active on Twitter. My new book, Aftermath, is a national bestseller, Wall Street Journal bestseller. I'm happy to say it's doing very well. You can help other people. You can you can provide an educational function where the universities are not.
Cool. Fair enough. So question is, your average person might say, well, this has always worked. We can just continue it. And it seems like there's a lot of people in the position of power that either haven't considered it or they just think that as well. Is it possible, right? So I look at it and I say the elites are obviously extremely powerful. And so I look at it and I say, is it theoretically possible that they can just continue this going forever, or would eventually we would just hit inflation or hyperinflation, or everyone would just start losing all faith in the dollar and that would cause a collapse? That's basically what would happen if they said, we're not going to fix anything, we're going to do this forever, right? Because part of me says, well, this seems like they can just prop it up forever.
Well, the answer is they can't. The answer is that we are getting closer to the point you just described. But I would challenge the first assumption a little bit, that the elites are powerful. Now, they're kind of powerful on paper. If you're the head of the ECB, the new incoming head, Christine Lagarde, or head of the Bank for International Settlements, or head of the Bank of England, or whatever. You have this, I'll call it apparent power. Like, yeah, you're the head of a central bank. That sounds like a pretty powerful job. But you're only powerful if you actually understand how things work, and none of them do. And they'll actually be the last to know. Like when this, it's not as if they're like, hey, we're heading for a crisis, I'm just going to get, no, they don't know that. And I always say it doesn't matter how many IQ points you have or how hard you work. Those are good things. Having a high IQ is good. Working hard is good. I don't disparage it. But it doesn't matter if you have the wrong models. If your way of understanding the system is flawed, you're going to get the wrong forecast every single time. It doesn't matter how much data you have. It doesn't matter how smart you are. If you have a bad model, you're going to get bad output every single time. And that's the problem with the so-called elites, Federal Reserve, IMF, Bank of England, Bank of Japan, White House, Treasury, all of them. They're working off very flawed models. Let me be specific about that, because I don't like to say things like that without backing it up. For years, Janet Yellen, when she was chairman of the Federal Reserve, she relied on something called the Phillips curve. Well, what is the Phillips curve? Well, in theory, it explains an inverse relationship between unemployment and inflation. So when unemployment gets really, really low, When the labor markets are strong, inflation goes up. And when unemployment is high and nobody can get a job, inflation goes down. And if you plot that on an XY axis, it kind of looks like this, inflation up. It looks like this, wrong direction. Unemployment's going down and inflation's going up and vice versa. That's the Phillips curve. Well, it doesn't exist in the real world. So the late 1970s were a period of high inflation and high unemployment. Today, we have a period of low inflation and low unemployment. Both of those are the opposite of what the Phillips curve would say. The Phillips curve says when unemployment's low, inflation's high, and when unemployment's high, inflation is low. That's what the Phillips curve said. But I just gave you two examples, late 1970s and today, when the opposite is true. So the empirical evidence, the actual data, says that the Phillips curve is junk. But they still believe in it. They have a theory that markets are efficient, the so-called efficient market hypothesis, that you can't beat the market and I can't beat the market because markets are driven on information. Everybody gets the information at the same time. Markets price instantaneously and nobody can beat the market. That's not true. I mean, that is the theory. That's what they rely on, but it's actually not true. There's inside information all over the place. And I'm not talking about illegal inside information. There is some of that. I'm talking about legal inside information where somebody just does better research. I mean, I know hedge fund guys, they hire satellites to count the cars in a Cracker Barrel parking lot. Cracker Barrel is a chain of, kind of moderately priced restaurants. Well, the thing about Cracker Barrels is they only exist near highways. So it's not like a downtown place, like a diner. They only exist on highways, so you have to drive there, and you can estimate how many average people per car, like 2 per car, or whatever you want to come up with, and how much sausage and pancakes people buy. So if you can count the cars in the parking lot, you can estimate the gross sales of Cracker Barrel before they announce it themselves, just by using satellite imagery. That's legal. That is inside information. It's material, non-public information, but it's legal because it wasn't stolen. There's this other condition to break those laws. You got to steal the information. This isn't stolen. You got it yourself. Well, there's tons of that information out there. I just gave you one simple example. So and markets, so why did the stock market drop like a stone the other day? Because Trump imposed tariffs on China, or he said he was going to delay the tariffs and the market went up again. Or, this trade war has been out there for 19 years and you can see it coming a mile away. Did the market price it efficiently? No, the market just gets hit in the head with a club and then says, I got to go way up or way down based on the news. So there's no evidence that markets are efficient. They're not. The theory is that risk is normally distributed. That's the bell curve. So it means that there are a whole bunch of small items and a very, very, very few, very small number of big jumps. Well, that's not true. You have these crises all the time. 1987, 1994, 1998, 2000 with the dot-coms, 2007 with the mortgages, 2008 with Lehman, AIG. These things happen all the time. They're not rare. They're not every 3 billion years, like Jamie Dimon said. And so my point being, all the assumptions of modern financial theory are incorrect, and that's not an opinion. I can give you data and time series to show that they're incorrect. So why do they cling to them? Because they like the math, because they invented them. They got a Nobel Prize for coming up with this stuff, even though it's all junk science. Well, if you're guiding monetary policy on the Phillips curve, efficient markets, and the other, normally distributed risk, if that's your working assumption, you don't know what you're doing. It's like driving a car blindfolded, and that's what central bankers do. So don't count on them.
Which I did recently.
Okay. Hopefully you're in a simulator or a test track. But the point is, if you're guiding markets with central bank policy using theories that do not correspond to reality, don't rely on that person to save your net worth.
So let's look at a few of those things that you said there, a few keywords. You said Jamie Dimon, which linked with obviously JP Morgan. You said China, and then we've talked a little bit about metals. So let me ask you, for people that don't know, and something that you point out in your books is that China and Russia are accumulating incredible quantities of gold.
Right.
Do you think that although it seems like it makes rational sense to put a percentage of the dollar backed by gold, do you think that that's even a realistic possibility how given that everyone is pretty much operating from a fundamentally flawed economic uh, and mathematical system that you just alluded to, do you think that's it seems like a good idea, but do you think that that's even a realistic possibility based off of how much blinders are on that something like that could ever really happen?
I do, and the fact that it's called Western central bankers, Fed, ECB, Bank of Japan. The fact that their models are so bad and their policy is so misguided actually makes some kind of gold standard more likely, not less likely. And we also need to separate two things. Number one is policy, rates up, rates down, how much money printing do you want to do or how much do you want to reduce the money supply? That's all monetary policy. You need to separate that from the role of the dollar, because there's no question that the dollar it dominates international commerce. So just to give you a couple of quick statistics, 60% of global reserves are denominated in dollars. Reserve is just like, if you make $1,000 and you spend 800, you got 200 in the bank. That's your savings. That's your reserve. Well, countries are the same thing. You have a trade surplus or a trade deficit. Well, if you have a surplus, that goes into your reserves. Well, you have a choice as a central bank or a finance ministry. How do I want to hold my reserves? Well, 60% of all the reserves in the world are in dollars. 80% of global payments are in dollars. Almost 100% of the energy market, oil and natural gas, is in dollars. So the dollar dominates global commerce and global reserves. There's no question about it. So if you go into a hospital, to the intensive care wing, and someone's on oxygen, you turn off the oxygen, what's going to happen to that person?
They won't be along very much.
They're going to die, right? Okay. Well, dollars are the oxygen of global commerce. And if I cut off your access to the dollar system, your economy is going to die. Well, we're doing that to Iran right now. We're doing it to North Korea right now. We're doing it to Venezuela right now. We have weaponized the dollar. We use the dollar. We cut off when I say access, Iran can sell all the oil they want, but they can't get paid because it's illegal. We, the United States, say that if you send dollars to Iran, you can't do business in the United States. Well, that's an easy one. Most of these so-called foreign banks do more business in the U.S. than they do in their home countries. They don't want to get kicked out of the U.S. to make a couple bucks in Iran.
What's preventing Russia and China from just coming out tomorrow and saying, hey, for everyone who wants to join us, we got a gold-backed currency?
Well, I think there's nothing preventing that, and I think that's exactly what they're doing. Now, timing matters. You have to have enough gold to be able to pull this off, and you need a counting system, a so-called numeraire, and a payment system. So you have to build all of it. You have to build a payment system, a unit of account. Now, it's not going to be the Russian ruble. It's not going to be the Chinese yuan. The Russia and China are working on a new cryptocurrency on what's called a permissioned distributed ledger. Distributed ledger is just a fancy name for the blockchain, but permissioned is the key word. Bitcoin, which I don't recommend, I'm not a fan of Bitcoin, but Bitcoin is permissionless, meaning you could mine some Bitcoin today. Maybe you are, same thing with me. We could mine Bitcoin sitting at home and send it or receive it or put it in a wallet or exchange it. Nothing is stopping us. We don't need permission from anybody to mine or transact in Bitcoin. But a permissioned ledger or blockchain is different. It's like joining a club. You can only use it if I say so.
Right.
Or in this case, Russia and China. So it's like, if you're in the club, great. But if not, you're out on the sidewalk. You can't come in. So Russia and China are building a permissioned distributed ledger,
So is this just your hypothesis?
No, they're doing it. I mean,
Putin
was photographed recently with I forget the guy who invented Ethereum. He's like I forget his name.
I know nothing about it.
But they're all over this. So they're actually building it.
Okay.
They're building. So this will be encrypted.
And you think he's specifically saying, and we're going to back this by gold, so people want to work with us as opposed to the U.S. dollar?
Correct. Well, what they're doing are two things. Number one, they have to get out from under the dollar system because, look at the countries who are under sanctions. I mentioned a few, but add Russia because of Crimea and Ukraine. Add China if you count tariffs and other section what are called
And if they can
301.
utilize Iran and Venezuela, then they can get oil and they can create their own mini economy between all their little allies.
Correct. So you have this new coin, a digital token called a Putin coin or a Xi coin. It's not the ruble or the yuan. It's a new
Right.
cryptocurrency. You use it to keep score. So Iran sells oil to China. China sells weapons to sells infrastructure to Russia. North Korea sells weapons to Iran. Russia sells natural gas to China. Everybody takes a vacation in Turkey. You create your own trading network, and you have all these payments due to and due from in this coin, not gold, but this coin. And then here's the key: periodically, once a year, twice a year, whatever, you settle up. So I sell a bunch of stuff to you, and I have a surplus in this coin. You sell a bunch of stuff to me, and you have a surplus in the coin. We net them out. See, that's the key. If you did everything on a gross basis, you would need a lot more gold. But if you use the cryptocurrency as a way to keep score and settle up on a net basis, you need much less gold. And they're getting there in terms of the amount of gold. And so this is completely feasible. They're building the technology, and they're doing it for two reasons. One, would they like to depose the dollar? Yeah, that won't happen overnight, but it's a step in that direction. But more importantly, it gets them out from under sanctions. You can't enforce dollar sanctions on a non-dollar system.
Got it. So makes perfect sense. So I own a lot of maybe 7,000 ounces of silver. I own none of gold. I've never even heard you talk about silver. Yeah. So what is your viewpoint on silver versus gold?
Silver will tag along. So gold has been going up a lot recently. I mean, it's gone up $300 an ounce in the past 4 months. It's gone up $100 an ounce in the past couple of weeks. So gold is skyrocketing, and silver has moved up too. Silver has gone from $14 and change to $17 and change. That's a big percentage move. Not that many dollars, but that's a 20% move. So I wouldn't subscribe to or make any bets based on the so-called silver gold ratio. You'll hear people say there should be 16 ounces of silver to 1 ounce of gold, and today it's about like 90 ounces of silver to 1 ounce of gold, and so silver's got to go up 5 times to get back to a 16 to 1 ratio. That's nonsense. There is no 16 to 1 ratio. There was in 1900. It was the result of silver miners lobbying senators to write a law that required a 16 to 1 ratio as a way to inflate the money supply at the time and help the mining interests. But it was pure legislative lobbying. There was no economic sense to it, nor is there today. Silver is harder to analyze than gold because it's a precious metal form of money, but it's also an industrial input. You use silver. Gold's not good for anything except money. Gold's the best form of money, but it's not good for anything else. And so that makes it easier to analyze. You just say, hey, it's money.
Why do you think gold is if, for instance, they instituted a new currency that was backed by metal, why do you think gold is better than silver for something like that?
Because it kind of meets all the conditions. It's scarce. It's not a fixed quantity, by the way. That's one of the problems with Bitcoin. I always say that the people who designed Bitcoin were really good applied mathematicians and coders, but they were lousy monetary economists. They didn't understand how monetary systems work. And they were so Nakamoto, if it was a person or a group or a man or a woman, or maybe it's a team from Raytheon working for the government to build a backdoor into every payment in the world, but leave that to one side. They were so fearful of central bank inflation that they put a cap on Bitcoin. There can only be, I think, 21 million ever, and we're getting close to that number. But that's a mistake because money supply has to grow with the economy. If the economy
why gold versus silver? Is it because you think, is your personal opinion, because silver still has an industrial use whereas gold doesn't, so it's easier to use?
That's part of the reason, yeah. Silver's more plentiful, easier to find. Silver actually tarnishes, gold doesn't. Take a piece of gold, throw it in the bottom of the ocean, come back 1,000 years later, it'll still shine. So there are a lot of chemical elemental properties to gold that make it superior to silver as a form of money. Having said that, silver is very useful. If you have a real breakdown in society, people forget that, if the power grid goes down, and I've lived through a number of big power outages in 2003 and Hurricane Sandy. I live on the East Coast, Hurricane Irene in 2011. Nothing works. ATMs don't work. Banks are closed. You can't pump gas because they run on electricity. There's just a whole set of things that don't work. The things that do work are cash. I mean, physical cash, if you have any. And silver is useful. If it gets worse, if it gets a little more like Venezuela, that might be something you can take down to a grocery store and feed your family with a silver coin. Gold is actually too valuable because 1 ounce gold coin would be like a year's worth of groceries. You just want a week's worth of groceries. So I think
for 5 years.
Yeah, I recommend people have a monster box. It's comes from the U.S. Mint. It's Treasury Green with
that's what I
compression seal, and it's 500 1 ounce American Silver Eagles, and you got your battery, your flashlights, your plywood, and your duct tape, and your monster box. So it's a good thing to have.
Got it. So you just alluded to if there is an outage or anything like that and you can't get to the ATM. So explain to me and to the viewer ICE9 and the realistic probability of that. When someone hears that, they say that's absurd and it's so cynical and that it can't possibly be any type of a realistic probability. Explain to me that and the cashless society and the elites plan that you allude to in your writing.
Yeah, that's a great question to wrap up with, Jake, and I'll finish with a quick explanation. So ICE9 is a concept I borrowed or stole, but as writers do, you always borrow from stand on the shoulders of giants. From Kurt Vonnegut. He wrote a novel in 1963 called Cat's Cradle, and it's a little bit of a dark comedy, if you will, but it involves a physicist who invents something called ICE9, and it's an isotope of water. And it's exactly like water, except it has two properties that are different. Number one, it's frozen at room temperature. So whereas water is liquid at room temperature, ICE9 is frozen. And number two, when ICE9 comes in contact with water, the water turns to ICE9. So what this means is that if you take ICE9 and pour it into water, all that water will freeze. The rivers, the oceans, all the water in the world will freeze, and human life on Earth will come to an end. So that was the doomsday scenario that Vonnegut was explaining in Cat's Cradle. So I took that concept, ICE9, and applied it to the financial system. I said, in the next crisis, they're not going to be able to do what they did in 2008. They're not going to be able to print that much money because they never normalized the balance sheet. They're not going to be able to cut interest rates because they never raised them. They're not going to be able to guarantee things that are already guaranteed. In other words, they had a playbook. It worked, at least if you're trying to avoid a depression, but you can't run the playbook again.
It seems like they can't also just be like, hey, we're going to bail everyone out again because people are still so mad about that. You can't just use that.
There are political constraints. There are psychological constraints. Absolutely. So they're not going to be able to run that playbook. Now, there is one clean balance sheet in the world that could come to the rescue and reliquefy the system, which is the International Monetary Fund. And they have a world money called the Special Drawing Right, geeky name, but that's what they call it, SDR for short. So they could print this world money, but I've spoken to the head of the IMF about it, and it's a little inefficient, and it might take 9 months to a year before they get around to that. So if you can't bail out the system the way you did the last time because you haven't normalized interest rates of the balance sheet and confidence has been destroyed, and if it's going to take you 6 months to a year to get the IMF to do the same thing, what are you going to do in the meantime? How are you going to prevent a complete collapse? Well, the way you do it is you shut down the system and freeze the accounts, and that's why I call it ICE9. And so close the New York Stock Exchange, close the banks, freeze money market funds, say, hey, we're not stealing your money, but you can't get it out right now. We'll get back to you on that. And just lock down the system and lock everybody into place. Call all the big hedge funds, call BlackRock, say, sorry, you can't sell anything. Just keep what you got, but you can't sell anything. Freeze treasury accounts, freeze the whole system in place until they can come back with a solution that would hopefully restore confidence. Well, when I describe this, people go, that would never happen. And then that's when you can point out to them, everything I just said has happened many times. From August to December 1914, 5 months, the New York Stock Exchange was closed. It was closed on 9/11. It closes every weekend, for that matter. It closes on holidays. New York Stock Exchange closes all the time. But at the beginning of World War I, it was closed for 5 months. 1933, Franklin Delano Roosevelt was sworn in as President of the United States. The first thing he did was issue an executive order, closed every bank in America. Every single bank was closed. They called it the bank holiday. That was their euphemism. And they didn't tell you when it was going to reopen. It did, in fact, reopen about 8 days later after a phony baloney stress test. But they closed every bank in America by executive order. Talk to people in Cyprus about banks closing. Talk to people in Greece. In August of 2015, summer 2015, people in Greece were flying to Berlin to get suitcases full of euros and came back to Greece with physical euros in suitcases because the ATMs were closed. The credit cards didn't work. The banks were closed. They couldn't get money. Every one of these things I'm talking about has happened multiple times, and they'll happen again. And if people want to turn a blind eye to it, they'll be on the wrong side of that trade. So when people sort of take me aside and they say, Jim, I hear you, I read your book, I listened to your speech or whatever. I think you're right, but call me at 3:00 the day before, and I'll sell my stocks and buy some gold. Yeah. And I say a couple of things. Number one, I'm not going to know the day before. I can tell you it's going to happen. You can see that, but I'm not going to know the day before. Or if I did, I'd be a little busy that day. But number two, and more to the point, what are you waiting for? Why don't you make some preparations today? You don't buy hurricane insurance in the hurricane. You buy it when the sun is shining, and you have it when the hurricane comes. So get your monster box today. Get your physical gold today. Have some physical cash. It's actually harder. People think they can go to the bank and get their cash. Good luck with that. They'll tell you to come back, make an appointment.
My business partner and I pulled out a bunch of cash for something we were doing for promotion, and we had to give them like a 5-day heads up.
Exactly. So you got a 5-day heads up, plus the bank will be closed on day 4. So make these preparations today. So Jake, great questions. I really enjoyed doing the show with you. Thanks for inviting me.
Yeah, no, I very much appreciate it. And thank you very much.
Okay.